Recently, the Australian Bureau of Statistics released the latest data showing that Australia's inflation has surged for 4 consecutive months, reaching 4.4% and still accelerating. Many people are concerned about whether the rising inflation will lead Australia back into a rate hike cycle, causing an economic recession and a housing market crash. Why does the Reserve Bank of Australia stand by as inflation rebounds? When will they start raising interest rates? Can inflation in Australia be controlled? What significant impact will a continued economic downturn in Australia have on our property investors? Hi, I'm Alex. Welcome to Aus Property Strategy, where I share information about real estate investment, economic trends, and wealth creation. If you like this video, smash the subscribe button and turn on the notification bell to watch new weekly videos. Without further ado, let's get into it. On 26th of June, the Australian Bureau of Statistics released data showing that inflation in Australia has accelerated again. The trimmed mean CPI rose by 4.4% year-on-year in May, marking the fourth consecutive month of inflation increases. The fastest rising segments include tobacco prices, up 13.4%, rents up 7.4%, electricity up 6.5%, fuel up 9.3%, and financial and insurance services up 7.8%. The trimmed mean CPI, which averages out and removes extreme values, is the inflation measure the RBA focuses on most. Many economists and major banks have started adjusting their expectations, preparing for the next wave of rate hikes in Australia. Some might say that the Australian Treasurer is confident that inflation will return to around 2.75% by the end of the year. Shouldn't inflation be calming down then? Well, this statement hides many traps that you might not notice. First, Jim Chalmers is the treasurer, serving the government and speaking for it, saying inflation will decrease makes the government's massive spending in the budget seem reasonable. If 30% of what he says is true, it's already good. Second, the treasurer is referring to headline inflation, which includes volatile items like food and fuel, unlike the RBA's trimmed mean CPI used for decision-making. The treasurer's CPI is more about public perception and less about economic policy and interest rates. Third, the treasurer alone does not represent the views of the entire academic and financial community. The Australian Financial Review surveyed 40 economists and leaders in the financial industry, with most predicting that the inflation rate, as the treasurer mentioned, will drop from the current 4% to about 3.5% by the end of the year, which is still more optimistic than many expect. Rabobank's chief economist Benjamin Picton has the most extreme forecast, stating there's a 60% chance of a rate hike in August and possibly 1 or 2 more hikes this year to control the current inflation trend and stabilize prices. The first rate cut may not come until September 2025. Other predictions are more conservative. However, speaking of being conservative, no one is more conservative than the RBA. 3 months after other countries started raising rates, Australia followed suit. When other countries reached over 5%, Australia only reached 4%. Australia's rate hikes were slower, and their peak rates were 1% lower. They were hesitant and couldn't take decisive action to curb inflation. And now, while other countries are discussing rate cuts after controlling inflation, Australia is dealing with an inflation rebound and may be forced to raise rates again. The RBA has lost credibility. Some may recall that the previous RBA governor, after the pandemic emergency rate cuts, assured Australians that low rates would remain until 2024. This led many to over-leverage their borrowing capacity, causing a refinancing crisis during the rate hike cycle, and businesses that followed the advice to buy long-term government bonds suffered losses. Now, the former governor's statements seem laughable. I have no confidence in the RBA. Their statements have little impact on my investment decisions and the decisions I advise for our Vision members. Regarding the RBA's reluctance to raise rates, my view is that they simply don't want to take responsibility. Similar to central banks in other countries, the RBA has 2 main duties: controlling inflation and maximizing employment. Raising rates would combat inflation but increase unemployment. The RBA's actions suggest that employment is more important. As long as employment is stable, slightly higher inflation is tolerable. This approach, however, disregards economic principles. To control inflation, people should have less money to spend, and more people must lose jobs to reduce demand and curb inflation. Attempting to control inflation without paying the price is unrealistic, especially without the government exacerbating the situation with increased spending, which also drives up inflation. The RBA's primary goal, although unacknowledged, is to maximize employment and slightly curb inflation on that basis. Without rate hikes, inflation cannot be controlled. The RBA should have started raising rates after the first quarter inflation figures this year, but they chose not to. as if waiting for inflation to self-correct. Without rate hikes, increased wages mean more money to spend, and all policies are aimed at preserving employment. It feels like trying to rescue a drowning person by reaching out further as they sink deeper, possibly dragging down the rescuer as well. The notion that having less money is society's responsibility rather than individuals is flawed. People should enhance their skills, start businesses, and earn more money, and investment is one of the ways to do this. This is why this channel exists, to teach people how to invest in the property market. A lot of people don't understand that owning property only costs you 2 cups of coffee a week. As the saying goes, when your neighbor loses their job, it's a recession. When you lose your job, it's a depression. I experienced the 2008 global financial crisis. I had just graduated and obtained permanent residency in Australia, working for a company for a while. I didn't understand what depression, finance, or unemployment meant at the time. Only watching colleagues getting laid off one by one. My company sold and managed properties, mainly commercial offices and some residential properties. The immediate impact of the recession was the tenants, various companies, either moved to cheaper places to save money or went bankrupt. Within a short period, 60 to 70% of offices were vacated, and our company's performance plummeted. The company I worked for, including the boss, had 10 people. After 7 colleagues were laid off, it was finally my turn. From my neighbor's unemployment to my own, and the recession turned into a depression. Then came over a year of unemployment, unable to find a job, and having to learn various skills to improve my employability because there was no other way. At that time, Australia's unemployment rate reached 5.9%. Now it's 4%. The RBA's interest rate was 3% after emergency rate cuts. Now it's 4.35%. Before entering negative economic growth, the GDP quarter-on-quarter was 0.7%. Now it's only 0.1%. All these indicate that Australia is one step away from an economic recession. The 2008 crisis was resolved for 2 main reasons. 1, the Australian government printed money, and 2, China undertook large-scale infrastructure projects, buying various minerals from Australia and injecting funds, resolving the crisis. Now Australia may need 1 or 2 rate hikes by the end of the year, and China can no longer undertake large-scale infrastructure projects and development like before to send wealth to Australia. This means Australia might face a medium to long-term continuous economic decline. I observed the public auction markets in Sydney and Melbourne and found a declining trend in auction registration numbers over the past 2 weeks. People are more cautious in bidding. Due to the expected rate hike in August, some buyers with insufficient funds quietly exited the market. According to CoreLogic, Sydney's preliminary auction clearance rate rose to 72% over the weekend, up from 63.9% the previous week. The situation is still good. However, in Melbourne, a large number of properties listed for auction lowered the clearance rate from last week's 72.9% to 68.2%. In terms of auction numbers, Melbourne now has 57% more than in the same period last year. Clearly a buyer's market with homeowners selling off properties. Currently, the number of properties for sale or inventory is 30% higher than last year and 16% higher than 5-year average. The data clearly show that in June, the Sydney housing market rose by 0.5%, while Melbourne was the only city in Australia where house prices fell, with a 0.2% drop in the month. The housing market in Brisbane, Perth, and Adelaide remains strong. Will Australia's property market be affected by rising inflation and rate hike expectations? In the short term, it will have a cooling effect on the market. Inflation is real, and whether rates will rise is not the determining factor for the housing market trend before the RBA meeting in August, but people's expectations for the housing market. Lower expectations naturally reflect fewer actions. However, Australia's fundamentals remain unchanged. Population growth exceeded housing supply, and the rental market still has a housing shortage. The situation varies in different capital cities, creating different property market cycle. In the long term, many factors need consideration, such as declining expectations for international students and immigrants' numbers, the possibility of Australia's economic recession, interest rate trends in other Commonwealth countries, and immigration and education policies. These all affect Australia's economy and policy. If you've made it this far, please give me a thumbs up, subscribe, and share this with your friends. Turn on the notification bell to watch new weekly videos, and have a good one. Bye-bye.